And welcome everyone back to Talking with Tarashuk Podcast. My name is Will Tarashuk. You know how to spell, but I'm going to spell anyway. T as in Thomas, Arashuk, and the world may be ending, or it may not. Who knows? We're going to talk about Silicon Valley Bank with my friend Steve Sosnick. Steve is an options trader, strategist, and market commentator. He is currently a chief strategist at Interactive Brokers, a leading online brokerage firm. Sosnick is also known for his expertise in options trading, and as well as written extensively on the subject. He is a regular guest on a financial news network such as CNBC, Bloomberg, and Fox Business. He also provides insights and analysis on the markets. Like I said, we're going to talk about SVB. The fallout, what happens next, what it means for you, me, businesses, everything in between. Steve, thank you so much for doing this. It's a little late on a Monday night, but hey, the news is constantly changing. I'm so glad I could get your last minute. How are you, sir?
I'm good, thanks. Well, it's whatever we say now, I hope it's still valid in an hour, let alone in a day or two.
Well, that's just typically how the news shifts, especially something like this. The Biden come out and he talked this morning, but he can talk again tomorrow morning, completely change everything. Even as I was writing notes, I had to change up a few of my questions. Like, oh, okay, so now I know how the FDIC is going to do this, or do I? I don't know. We'll see. But first off, just kind of introduce yourself, right? What you do professionally, and I guess why you are kind of knowledgeable about this topic and why you give credibility to my podcast and being a guest.
Well, that's a tall order, Will.
Please. Tell me a whole life story, Steve, right? You got 30 seconds.
Okay. Well, I was born in a humble background. No, the professional aspect of it is I've spent far too long as a trader on Wall Street and relatively recently, not that recently, moved over into a strategy role. What that means is I started out at the big firms. I was at Salomon Brothers. I was at Lehman Brothers. I was at Morgan Stanley until I realized maybe the big firms weren't for me. And then I started at this little firm called Timber Hill, which was a decent sized options market making firm that was trying to get bigger. That was 25 years ago. Along the way, we changed our name to Interactive Brokers, and we got a lot bigger. And I helped manage our option trading business. We were the largest option market maker and specialist firm in the world at one point. We moved away from that business because, quite frankly, we started this little side business of electronic brokerage, and that turned out to be a much bigger business than the option market making business. But along that way, I started to be like the one guy other than our chairman, Thomas Petterfy, who was allowed to talk to the press. So I started writing a couple of guest columns. Well, started getting quoted here and there from one or two people. I was allowed to write a guest column in Barron's, largely because I'm friends with the regular columnist, and he let me keep his seat warm when he would go on vacation. And that led to, becoming a talking head. So as we were de-emphasizing proprietary trading, I was creating a new role for myself, which has, I got to admit, been a lot of fun. And I guess, it's interesting because I get many more phone calls when things are a little weird, as they are now, and as we're going to discuss for the next hour. Maybe they're a lot weird today. And I guess because, I had this role sort of just making sure our options market making business didn't blow up. It was really just, stamping out little fires here and there, or sometimes some big fires, that I think has given me exposure to a lot of different workings of the financial markets. And, quite frankly, having been around long enough, I've actually seen a couple of cycles. And so, so here I am, and I hope to, enlighten the listeners.
Yeah, it's interesting you said the word cycle. I was talking to someone today, and he said, "Yeah, I was like, is this the end of the world?" He goes, "No, it's just the reset of a cycle." I'm like, I don't know if I like the sound of that. It's the restart of a cycle, because I didn't know. I guess the economy has its ebbs and flows, but it being cyclical, that's an interesting way to look at it. But I'm sure we'll get into it. So this is just to start us off, right? Silicon Valley Bank, the second largest bank collapse in U.S. history. The first, of course, being 2008 financial crisis. So, from what I understand of the bank, it's the 16th largest commercial bank. It serves technologies, life science, healthcare, venture capital industries. It became a leading provider of financial services to startups, venture capital firms, and high-growth technology companies, which I believe tech makes up, 20% of the economy, U.S. economy, give or take?
Depending on how you slice it and how you define it, I'll say yes. But yeah.
So a pretty big bank. Right? The bank had about $209 billion in assets, give or take. I heard anywhere from 160 to 180 to 209. So however many, who knows? So anything else, like, what else do you know about this bank? Kind of fill in the gaps that I just laid out there. I think it's a pretty solid, this quick Google search. But anything else that you know about this bank, that what it does, and like how it became the 16th largest bank in the country?
Here's the crazy part. I only barely knew of this bank's existence, being an East Coast person,
Right,
and not being, what I would call a tech insider. I certainly, you and I and your colleagues at NASDAQ have had plenty of conversations about tech stocks, but interestingly, a lot of them involve the NASDAQ the NDX, the NASDAQ 100 index, which is explicitly a non-financial index. And so SVB, or its symbol was SIVB when it traded. SVB was only sort of out there on my radar. I spent most of my professional career as the specialist in bank stock options. But by the time that this one really arose to be one of the largest banks in the country, I was winding that part of my career down. So this one kind of came out of the blue as well. What they did is they became the banker, as you mentioned, to the tech industry. And so what would happen would be they would cultivate relationships with venture capital firms, other early stage investors, and became their bank of choice. And so as the companies became flush with cash, these, as the venture companies got funded, well, where are you going to leave it? Our bank seems to be Silicon Valley Bank. They seem to be good. We'll leave the money there. One of the things we've learned here is, that sometimes if you're a good technologist, you're not necessarily a good financial person. And I think, and in this case, most banks are fairly opaque. And so you had a lot of companies leaving a lot of money in this bank just sort of because everybody else did and because it seemed safe. Unfortunately, that we didn't really know what was under the surface. A lot of people miss this, including the Fed, including the Fed and other regulators. So I hope that explains it in a nutshell. But basically, it was at some level a victim of its own success.
Interesting. So not everybody didn't see it coming, because some parts of the internet, depending if you believe or not, some people in the company saw it coming. So like the CEO, for example, Greg Becker, he sold 11% of his shares on February 27th. The counsel, Mike Zucker, 19% on February 5th. CFO, 23% on 2/27. Michelle Draper, CMO, sold 25% on February 1st. So they knew something was up, right? So like that in and of itself, right? Let's just take the people up top. If they...
But that's opaque. See, that's the problem, is they see it, the rest of us don't.
Right. So are they under any obligation to inform people? Or they kind of just let it happen? And while they walk out the back with this, they still got their money. Their executives they still got their bonuses, right? So like, is there any liability on that end?
I'm not a lawyer, and so I'm not going to play one on this podcast.
Fair enough.
If I was their friend, I would be telling them maybe you should find a good lawyer, because there's certainly going to be people looking to claw back some of that money. They used what they called 10B1 plans, at least the chairman did, and a lot of people hide behind that. There are 10B. It's meant to be sort of a regular stock sale program, and you do see it used benignly. I know, there are executives who sort of sell 500 shares of stock every single day. Well, that's a pretty benign use of a 10B1. That is truly mechanical. In this case, they claimed it was a 10B1, but then did some outsized sales. And there were some short sellers who did make out on this. There were some people around who did sort of warn of this. But this was the problem, with banks. Somebody asked me last week, what's the book value of SVB? And this was as the FDIC was closing it down. I said, well, negative, obviously. But, if you looked at financial statements, it looked like it was a fairly robust bank, unless you really looked under the surface. And that not everyone is equipped to do that. Not everybody does it. I'm not, I don't get into the balance sheets of a lot of these companies. I'm not a bank analyst, but even a lot of bank analysts missed it. What they did here was In this case, though, it was less nefarious and just stupid. The one thing I will say, though, which is a little interesting, is, and I'm citing a report by The Guardian, so that I want to be very careful that I'm not making this up. The chairman of the bank also, several years ago, was one of the people lobbying for the changing of this systematically significant financial institutions. Basically, in the aftermath of the global financial crisis, they realized that there were certain systemic financial institutions that needed an extra degree of scrutiny and regulation. J.P. Morgan, Bank America, et cetera, et cetera. And the cap was, the threshold was $50 billion. And as SVB approached $50 billion, their chairman was one of the people lobbying to get the rule changed up to $250 billion, which did happen. And so as a result, this one probably should have been considered a systemically important institution by the old rules, but thanks partly to the chairman's lobbying efforts, the rules got changed in their favor. So you can't separate the politics and the behind the scenes stuff in any of these situations. There's always something going on. But I have to be very careful not to cast aspersions. I have to be very careful and like what I said, I'm citing a published source when I say these things. But yeah, there's certain aspects of this that definitely don't necessarily pass the smell test on the surface.
It's weird. I would tend to agree with you. No, I am also not a lawyer, an expert in any way, shape, or form, but just to sniff test, I would say that it's definitely more, in my humble opinion, it would be more like stupidity than like malice. Now that would be my guess. But
this one really was stupidity, actually, right, when you came down to it. What happened here, and this is, I guess, a good way to explain the hows and the what's ups.
Yes, please.
When you think of what a bank does, basically, is it takes in deposits, and I'm oversimplifying dramatically, but a really plain vanilla bank, George Bailey, takes in deposits from depositors and lends them out to businesses and individuals for mortgages, for business loans, et cetera, et cetera. That really is like the It's a Wonderful Life idea. Now, the problem is deposits are by nature short term. They're called demand deposits, which means I can demand them back at any given moment. On the flip side, though, there's not a lot of liquidity in someone's business, in Mr. Gower's pharmacy, let's say. You can't necessarily call that loan right away. So the banks there's a certain fragility in this. They're borrowing short term and they're lending long term, and have to appear safe and solvent so that too many people don't demand their money back. What happened in this case of Silicon Valley Bank is a lot of their customers got a lot of money. Think of all the money that's sloshed around in the post-COVID world. And I'm not just talking about stimulus checks going to people. I'm talking about investments in SPACs, right, and all sorts of IPOs that maybe shouldn't have happened.
And it is fair to mention that the bank itself, most of their clients were businesses, right? So yes, businesses got more PPP loans or whatever loans from the government during COVID. So they had an influx of cash.
But it's way beyond that. Right. Well, these are corporate transactions, okay, or companies doing their banking. Roku had $460 million in the bank. Circle, the stable coin, had $3.3 billion at the bank. So, we can argue whether that money sloshing around in Circle should be there or not. I will say that crypto as a whole is a easy money phenomenon, mm-hmm, shall we say? Mm-hmm. And so there was that kind of money going around looking for a home. Well, the bank, pays interest on those deposits. So what did the bank do when it got all this money? It didn't necessarily lend it out to, in the case of mortgages and other corporate loans, because these companies didn't need business loans so much necessarily. So the bank put it in what appeared to be very safe securities. They bought treasury bonds for the most part, or government agency mortgages. There's not a lot of credit risk on those, theoretically zero, but there is duration risk. So remember about that part about borrowing short and lending long. Well, the problem is, even in the case of something like government bonds, which are very liquid, relatively speaking, they are subject to price fluctuation. And so you had short duration borrowing and long duration lending. Now, remember, so assets. And so the assets on their books, as rates rose, if you buy a bond and prevailing interest rates rise, bond prices fall. And so they had to keep ratcheting up the price of their deposits, or at least stay in line with the market. But meanwhile, the value of their assets was falling. And this is what happens. You've heard the term inverted yield curve, meaning that rates in the short term are higher than rates in the long term. Well, if you're borrowing at a higher rate than you are lending, that's not a recipe for success for banks. And these guys got caught up in liquidity. It wasn't credit. Most of the global financial crisis was a result of silly credits, banks lending to people who shouldn't have had mortgages, or all sorts of crazy schemes. In this case, their loans were going to the government, which is not a particularly productive thing necessarily, but they got them marked against them. And so when people wanted their money back, they had to sell down some of these long-term bonds.
Right. And they just sell them at a loss.
And they sold, well, not just a loss, $1.8 billion loss. And that, of course, got people's eyebrows raised. What's going on there? How bad are their books? Let's take our money out. And that's when it became sort of the old-fashioned bank run. And that's what the Fed and the Treasury had to step in and take care of. I think they were hoping to do it over the weekend. They like to deal with problem banks over the weekend, but circumstances overtook them and they had to close it down on Friday.
Well, that makes sense though, right? And when you think about it, it makes sense that this would happen really on a Friday afternoon. So the markets close over the weekend. They can kind of prepare and make a plan, because otherwise it would just crash the next day, like almost like that. Whereas suppose Monday, they can plan some things out. So that totally makes sense to me. But I'm going to backtrack a little bit so essentially I need to kind of simplify a little more. Bonds. This is a term I've heard a lot over the years. I kind of know what they are: government bonds, treasury bonds. Can you explain this basic 101, what bonds are and how they work?
Bonds are a securitized way of borrowing money. So for example, if you want to go borrow money to buy a house, you would go to the bank and get a mortgage.
Yep.
That's really a contract between you and the bank. But if you're IBM or the federal government or Microsoft or someone of that nature, you may find it more prudent to go out to the markets and ask the market for money. So it's a tradable, standardized instrument that has a fixed maturity. I promise I would like to borrow $100 million and I will pay you back in 5 years, and I will pay you 5% interest on with coupons semi-annually, give you semi-annual payments. And as a result, the market can value that. You can then value, is 5% a good yield based on the credit worthiness of the borrower and based on the prevailing interest rates. If interest rates are 7%, 5% coupon is pretty lousy. Right. And so that bond will have a value less than par. They're usually in $1,000 increments, but everybody always quotes them as percentage of par. So in that circumstance, the 5% bond, let's say it's a very good credit, but if it's 7% prevailing interest rates, that bond is going to trade, I'm just making up a number, 96 cents on the dollar, 92 cents on the dollar. If interest rates are 2 or 3%, well, that bond, people will want that 5% coupon, and the bond will trade above par, by some sort of increment called 102, 105.
It's like a loan that changes depending on the market.
Well, the terms of the loan don't change, but the market price,
the interest would change.
No, the terms of the loan stay fixed. The amount that there are floating rates, and I'm trying to avoid talking about floating rate debt and all this other stuff. But let's take a plain vanilla, the government bond. The government has huge borrowing needs, and the vast majority of their debt is what's called fixed coupon debt. And so what happens is they do different bond issuances. So we're going to borrow $100 million. So that amount is fixed. We're going to we're going to set a maturity that's fixed. Let's call it 5 years. And we're going to set a coupon. And these government bond auctions go off all the time. They usually get priced somewhere around par, but not exactly. But because, without getting too mathy, there's the present value of cash flows. And what we want to do is figure out, there are equations, and I'm going to ask the listeners to look them up because I really don't feel like getting into them on this, and you don't want me to get into them on this.
Keep it simple, please.
Exactly. And so the bottom line is, if I'm going to give you $1,000 now, or give the government $1,000 now, and get back $1,000 5 years from now, and along the way get 5% a year on that original $1,000, there's a value to that, and that value changes based on interest rates.
Right.
And we're going to use the example of the government because I don't have to worry about credit. If there's a perception that the loan's not going to get paid back, well, then that decreases, all things being equal, that decreases the price of the bond. But so in a very simple sense, it's a publicly traded piece of debt. But the bond markets are very large, very efficient, and you have a lot of people who have the kind of calculators that can price out what the present value of that is. If based on prevailing interest rates now, based on my alternatives, other things that I could do with the money, what is that worth at present? When interest rates were zero, well, people really wanted pretty much anything with a coupon because you couldn't get them. Now, when rates are higher, and depending on when this goes live and when somebody's listening to it, they could be any place because they've been all over the place. But I will guarantee you they're not going to be zero. And so the higher the prevailing interest rate, the lower the value of that coupon, and vice versa. And so that's really what changes it. So in the world of government bonds, there's everybody marking these things to market constantly. It moves regarding interest rates and market forces. But in the case of SIVB, they put it all on these longer term bonds when rates were very low, when things were not having good coupons. And as a result, when rates went higher, the value of those bonds fell, in some cases fairly sharply, even though eventually they'll get paid.
It's also a problem of they didn't have liquidity, right? That's why they had to sell their bonds. There was not
exactly.
Liquidity is this little cash, right? Like I have $10,000 in my bank account and another $50,000 in investment. My net value is what I say, 50 and 10, 60,000. My liquidity is 10,000, right? But the problem with assets is assets change in value consistently. Like if you buy a house for $400,000 and you retire 60 years later, it's worth $1 million, right? Assets change in value. So.
But a house is illiquid. So if I told you I need you, you've got the house and I need you to sell that house, you're not going to necessarily sell it. It may say, if you go to Zillow, it'll say your house is worth $400,000. If you go to sell it, there's nothing that says you're going to get $400,000. Plus there's going to be an agent's fee and everything else. So that really does play into liquidity. Houses are illiquid.
So I think this is more of a question of just a general the general economics. Like when we say net value, like if the company was worth billions upon billions of dollars, that's including all of the assets. Why do we categorize like that instead of, no, they're actually worth what the liquidity is. Like they're actually worth how much cash they have because the assets are fixed, right? The liquidity can come and go, but it's pretty much basic math. The assets can just fluctuate all over the place. So when we say with the net worth of things, it's why do we put more weight on the assets than the actual liquidity?
Well, you shouldn't be.
But we do.
We do, but it's sort of a misnomer. Mm-hmm. Remember here, there's something very important. The basic accounting identity is assets minus liabilities equals equity. And really, everybody should be focusing on what the net equity is of any enterprise, whether it's a company, whether it's your personal life. I mean, if you have $1 million house and have a $1.1 million mortgage, your equity is negative $100,000. If you have a $400,000 house and a $200,000 mortgage, your equity is $200,000. So that is how you think of it, and that is how analysts do think of companies. But we always get tripped up by that, because you're right. We do tend to think about the assets. And then, of course, within the assets and liabilities, there are liquid assets and illiquid assets, and there are current liabilities and long-term liabilities. And so, there are various accounting identities that people use. They call them current ratio. So, what can happen is, and you've heard me talk about this. One of the things I always like to focus on is cash flow. When we talk about, is a company making money or not, they always talk about the earnings per share. And then I always want to see what the cash flow is doing, because you know what, you can use all kinds of accounting tricks to massage your earnings per share. You can say that this was a one-time item, or this, this is a non-recognizable thing, or we're gonna exclude this, that, and the other. But you can't fake cash flow. And so cash flow is what keeps it current. So all these things sort of work in tandem. There is no one way to measure it, but you're right. If you're just focusing on assets, you're really not getting at anything close to a complete picture. You can look at someone and say, oh, he's got a $5 million house and a Ferrari and a Lamborghini. Well, but if he's indebted up to his eyeballs, he's not worth a thing.
Yeah, the assets are only valuable if the liquidity is there to back it up.
Well, but you have to have the liquidity. You have to have more assets than you have liabilities. Mm-hmm. And you have to have the liquidity, the cash flow to service your debts. So, in that example of the guy who's hyper levered, if he's got a job that pays him, $1 million a year, presumably, as long as he keeps his job, he can stay current on all his debts. He could pay his mortgage, he could pay his car payments, and soldier on, and so be it, and just hope he doesn't lose his job. If that all comes to a halt, well, then he doesn't have the liquidity to service his debts. He owes money on that house. He owes money on those cars, and people are going to be looking for it. Well, then what happens is at some point they're going to either foreclose, they're going to repo the car, they'll foreclose on the house. But the lenders don't want to do that, because they know that if they take over a $5 million house, they may not be able to sell it for $5 million if that's the value of the mortgage. If they take over the cars depreciate. They may not be able to sell it for that. So it's very much intertwined. So liquidity is really your earnings or your cash flow. In the case of a person, it's your income. In the case of a company, it's really some combination of income and free cash flow. Can the cash flow service the debts? And are the debts less than the assets? If that equation flips over, you're in real trouble. And in the case of SVB, the liabilities were greater than the assets, and they did not have the cash. And certainly when everybody demanded their money, and their only assets were relatively illiquid, they had to take a haircut. And that's where the bank run comes in.
Well, it sounds like a big hot mess. And, fingers crossed that it gets worked out. Fingers crossed this isn't a domino effect. And is it a domino effect? Well, we don't know. As of recording this on Monday, March 13th, we don't know. A few other banks, one in New York, one in San Francisco, has failed. Now, is that related? I have no idea. But let's stick to one bank at a time. So, insuring the money, right? Because, I use TD Bank. I also use Wells Fargo. Those are FDIC insured, I'm sure. Right, but it's $250,000 per account. Right now, that doesn't matter if it's a business account or a personal account. Now, personal, that makes sense. Right? I think $250,000 is a fine number to insure money for a personal account. But businesses, why isn't that a higher threshold? Why isn't it $250 million for businesses? Because businesses typically have more than $250,000 in the bank account.
The logic, and we can argue whether this is true or not, is the whole point of FDIC was there to protect individuals, because it was created in the aftermath of the Depression, when when literally you'd see the movies of people lining up outside the bank waiting for the money, and so it was the thought was that smaller investor, I'm going to call them investors, but just individuals aren't going to do the credit worthiness. You don't know if TD is better than Wells Fargo or better than XYZ Bank, which is down the street. And the whole point is to make you sort of indifferent to that. The average individual is not in any position to do bank analysis, parenthetically, as we learned. Neither are a lot of bank analysts. on parentheses. But so the thought would be, so it was $100,000 actually before the global financial crisis. That got raised to 250. The idea, the thought would be that if you're over 250, you should be sophisticated enough to understand whether a bank is risky or not risky. I'm going to argue that, I got to believe the corporate treasurers at a lot of these companies should have had at least the smarts to be able to figure it out, whether SVB was dodgy or not, but they really didn't have all the data available to them. And they also rely on regulators, and the regulators they either had the data and didn't use it or didn't have the right data. And so, I think the idea of just distinguishing between individuals and businesses is not necessarily fair. You could think of any number of small businesses that would have, a relative, call it $250,000 or less. I would say the vast majority of small businesses in this country have that or less. But, let's say, for example, you're going to build a new factory or something like that, and you might borrow $1 million from the bank, but before you break ground, you've got $1 million in the bank. And so I think that you're not necessarily doing the credit worthiness. You've always dealt with this bank, and so there's no reason, you have no reason to believe they're going to go out of business, and they just lent you $1 million. You're going to leave it there until you actually, as you spend down the money on what should be a productive investment for your business. So it's a tough thing to distinguish, and I think but what they did here was to avoid the contagion, was to say, all right, we're just going to guarantee everybody's deposits. So effectively, we just threw the $250,000 cap out the window. I think in the short term, it stemmed the run on banks. You're not having people saying, give me my money. But what it still did was it made people very wary of investing in their stocks and bonds, because the stockholders got wiped out. And the bondholders, we don't know what they're going to recover. So people got very wary about that. But in the short term, I think it did stem the run. You didn't really hear of any runs coming today of people, trying to get money out. There was one that was maybe there, but they were able to secure some funding. So we'll see what happens. But I think that part was safe. But then the other part is, well, what does it mean to be in a world where we had this $250,000 insurance limit, and now basically, let's forget about it.
Yeah, so now it's just like, they're not going to put it back, right? So now it kind of sounds like, well, they're just going to do this forever. So like the FDIC, right? They have the money, but how do they insure it, right? Where does the FDIC get the money from? Now, is their money they have, is that locked up in assets? Do they got to sell some stuff, or is it all liquid? It's coming from the government. They're going to print it. Is Peter Pan going to come in? Woo! Here it is. Like, where is the money?
It's an insurance company. The banks pay premiums, for the same, just like you do on your house or your car. I don't exactly know where they keep it. I think they actually just keep it at the Treasury, where, and the Treasury, and in theory, it's just sort of, it's all book entry. It's not like there's this huge pile of money somewhere in the Treasury.
So it's just ones and zeros on a computer then.
Exactly. But the Treasury, is really the U.S. government can, more or less print money if it wants to, so to speak. And so in theory, the banks are paying insurance, and there's a formula for, how much you have to insure. Obviously, a large bank has to pay more FDIC insurance than a small bank, et cetera, et cetera. The problem is now the insurance premiums were set based on a maximum payout of $250,000 per person.
Right. And now they're going to skyrocket because there's no.
And so now, presumably, they're going to have to raise those. Exactly.
And they can price them at whatever they want based on the risk of their business.
Well, we don't know. See, this is the problem because there's so many moving parts. If they want to do it right, it may have to be set at a number that's so prohibitive that the banks are going to basically be able to pay even less in interest than they already do in some cases. And so this is all being done on the fly. And when you do this on the fly, I understand why they did it, because they could not have they really just did not want to see a series of sequential bank runs.
Right. Because that would lead to a domino, and like, God forbid, right, that everyone, I always made this joke with people, right? If everyone went to the bank and went through their money, they'd call me with this end. That's
absolutely.
Now it's kind of like, well, that's not really a joke anymore. That's actually kind of possible because there's not enough money. There's not enough liquidity for everyone's assets. So when you break it down like that, is money actually real? Like honestly though, like if we all went to the bank and everyone did a bank run, money would just cease to exist. It just wouldn't exist. So if the government can just print the money and it's just ones and zeros in a computer, just give people money then.
Money, once we stopped using gold and silver coins, doubloons and stuff like
God,
that.
I could talk about this with Nixon in the 70s forever. Come on, please continue.
Money and credit became inextricably linked. Money is credit. Right. Banks, in a way, create money because what they do is they only have to keep a certain fraction on reserve. That may have to change. That may have to go up. We'll see about that. Right. But what I forget what the exact rate is, and I'll just use 10% as an example. But so you and I give the bank $100,000. They can actually then lend out $1 million if someone will let them. If someone will, and so the banks actually create the money under the auspices of the Federal Reserve and the Treasury and the controller of the currency and all the other various, 3 and 4 letter agencies that they report to. But the banks are the ones that create money. It's all a system of credit. And so so everybody does have to, there is a certain element of trust out there that involves the monetary system.
It's interesting to say it's a credit. You use the word credit. I would use the word debt, right? This country is run on debt, and who owes money to who?
Well, one person's debt is one person. One person's debit is one person's credit. I mean, that's again, we're going to go back to the basic accounting thing. My asset is, but basically, in the case of banking, someone's asset is someone's liability. That's why you have to net out the assets and the liabilities. But the problem is, again, not all there. You have where you fall into problems with banks is you have this mismatch of assets and liabilities. The liabilities are, in theory, anyone can go into the bank and demand all their money on any given day. It only works because everybody doesn't do that, because everybody has some faith in the banking system. But yeah, you're right. And that was really the root of the Great Depression was the banks got way out over their skis. There wasn't a lot of regulation, and people would run to the bank. You get bank runs, and one would, and it would be like dominoes falling. And when that happens, because the banks created the money to a large extent, right? Our 100,000 becomes $1 million circulating out there. Well, the flip side is when there's a bank run, the money disappears. And so you have this monetary shrinkage. And so I think that's going to be another interesting little feature, because you didn't lose the deposits. The deposit nature of the bank didn't deflate away. But basically all the equity holders are looking at potentially zero, and all the bond holders are looking at a big haircut. Well, that's a lot of money that just vanished. Those are someone's assets that are at best impaired, at worst vaporized.
So, but where'd it go? Right, it's got to go somewhere. Like if the $100 billion just disappears, it's got to go. Someone has to have it. It's got to be. It's just gone. It's just in the ether.
It's gone.
But where'd it go?
It vanished. I know that's the crazy part of it, because it didn't really exist in the first place.
That's my point. There it is. There it is, Steve. The money didn't exist in the first place. It's just ones and zeros. It exists because we all agree it exists, right?
Boom. That's exactly what I was going to say. It exists because we agree it exists. It exists because we believe in this system that allows it to exist.
So the market truly runs on confidence. Like that's it.
Absolutely.
The market only runs on. You know what, Steve? I would prefer a market that runs on money instead of just confidence.
But money is money
is money.
System money is
money. Money is a physical thing. Here, I got my wallet here.
No,
right?
it's not.
No, it's not, because it's a piece of paper.
It's not.
No, you're right. It's a piece of paper.
It's the promise.
It's the value. Yes. You know what? You're right. Damn it.
It's not. The only, money is, money realistically is basically, if you want to go back to the root of it, it's a system of barter. I've got, I'm growing tomatoes in my backyard, and I'll trade them with you for
dig this hole for me. Yeah.
Whatever.
Build this window for me. Yeah.
For some, for some goods or some services. Mm-hmm. in reality, that's a very inefficient way to run things. So money existed. The original forms of money were gold and silver.
Coins.
Why gold?
Iron.
Why gold and silver? What's the inherent value? What
Shiny.
Yes, gold.
Yeah,
yes,
shiny.
gold.
But
gold
again,
has utility.
it's because we all agreed this gold piece equals this.
Exactly. Gold has inherent value. It's a good conductor of electricity. Not that it mattered to people then. It's shiny. It's not all that plentiful. It's malleable. And so it became the instrument of currency. Obviously, there wasn't enough gold around to do all your transactions, and that's silver was more plentiful and had many of those qualities, and so that became a means of exchange. It could have been anything, but even there, that's because everybody agreed to accept gold and silver coins in exchange for all these things. It then morphed into to a credit-based banking system, credit and debit-based banking system. But it's all short of like trading actual goods and services, at an individual level. You need everybody's got to agree that this medium of exchange has value.
Steve, I'm glad you're the one to kind of blow my mind on that one, right? Because I'm a big fan of gold. I wish we would go back on the gold standard because money was actually more valuable back then. But to your point, it's the same thing. It runs on the confidence. Gold is only worth that much because we have a system in place to make sure we all agree it's worth that much.
Exactly.
Damn,
right? I mean, we you can check the price of an ounce of gold. But again, that price of the ounce of gold is in exchange for dollars or yen or whatever else. So even there, because you're not going to, the bodega and buying a soda with a gold coin. If you hold gold, you still will, for practicality's sake, you're going to convert it back to some other currency that's generally accepted as a means of exchange. And your hope is that the gold that you own can be exchanged for more dollars or yen or whatever sometime down the road.
Right. So theoretically, right? Why is inflation even a thing then? If the money is the dollar is worth like 10% less because 10% inflation, can we always be like, nope, it's not. It's back where it was 100 years ago. Like we could just do that, right? I don't know how you would do that, but you theoretically could just do that.
Well, if
this philosophical conversation of money is just what we all agree it is, how do we have inflation then?
Because because as more of it is printed, as more of it comes out, as we live in a debt-based world, where the banks are incentivized to continue to pump out money. Well, the more money that exists, the less each dollar is worth, or whatever we want to call it. Gold had inflation too. There was massive inflation
in 1970s. Yep.
I'm going to go back way before that. There was massive inflation in the early 1500s. Why? And think about why. If it was a gold-based economy, why would there have been massive inflation?
1500s?
Yep.
Oh God, that was before America. Man, what was going on in the 1500s? Is this in Europe?
The conquistadors found loads of gold in America and brought it back to Europe. And so
it was an influx, right? Too much supply.
Yeah, so there was a relatively fixed amount of gold because it was difficult to mine. It wasn't all that plentiful, and all of a sudden, the Spaniards found all this gold in the New World and brought it back to Spain, and as a result, it actually devalued gold to a certain extent, meaning it took more gold to buy a certain amount of goods and services. That's inflation. The reason gold has been typically considered an inflation hedge is it's relatively fixed. Whereas if we're talking about ones and zeros and credit and fractional reserve banking, well, that can continually go up. The problem is if you live in a debt-driven world like we do, inflation is bad, but deflation is worse. Because you want to be able to, if you borrow the money to buy a house, right? Let's go back to your $400,000 house. So if you have your house and you take out a mortgage that's worth call it $300,000. Just keep the numbers easy. If there's a little bit of inflation, you remember what I said about the present value of money. So in theory, that $300,000 in today's money is really, it's worth $250,000 by the time you're done with the mortgage in 15 or 30 years. Meanwhile, in the meantime, hopefully inflation has picked up the value of your house so that you'll be able to sell your house when the time comes for $450,000 or $500,000, that kind of thing. So if you're in a debt-driven world, you need a little inflation because you want it incentivizes borrowing of money. The problem is it gets out of hand. It impacts people's living standards. Those who are lending the money don't really want to just keep lending it too much if there's too much inflation. And so sort of we've arbitrarily decided that 2% is the number. Deflation is a problem because you don't want to be paying back in real terms more money than you borrowed. That's a real problem. You at least want to just be paying back. You want to be paying back in real terms no more than what you borrowed. And you certainly don't want the value of the assets that are behind that debt. You don't want them to depreciate. So that's why inflation is bad, but deflation is worse.
No, that does make sense. That makes sense.
Yeah. So here we are.
Here we are. All right. So now we're gonna look forward. Moving forward. So the government is saying they're gonna retain all the funds. So I guess there's three ways they can do this, right? They can raise taxes and pay for it that way. They can print money, which is going to cause inflation, or they can have the banks pay for it, right? Somehow make the banks, right? Correct me if I'm wrong here. They can have the banks kind of front the bill, and then the banks are just going to pass that on in fees and other things to the consumer because they're not going to pay it themselves. Why would they do that? They want a business. So, is there any way that we can get ourselves out of this without like the middle class, regular people, Main Street just being absolutely hosed? I don't see a way that the government can just do this. Also, this seems very uncapitalistic, right? If the capitalism is like, let them fail. It's capitalism, right?
I'm not going to argue with that. We've privatized in a system like this. We privatize profits and socialize losses.
Oh, I'm so glad you said that because I had that written down in all caps. Now, it's fine to do. I'm not going to say it's fine to do that. I don't think it's fine to do that. But I don't ever want to hear a politician or anyone saying this is a capitalist society because it's not. I'm going to say it's bullshit. I'm going to say it's straight up bullshit. Because what happens now? Because you can't let the banks fail because that's going to cause a domino effect. It could. You don't want that. But this plan B doesn't seem much better because, as you kind of talked about earlier, the rich people are going to walk with the back with all the money, whether that's they can or can't, lawyers, we're not lawyers. But Main Street's going to get hosed one way or the other.
I'm not sure Main Street gets hosed. In some ways, Main Street doesn't get hosed because because let's go back to that example of a decent sized business person who wants to be able to know that whatever money they're putting in the bank will still be there when it comes time to pay their bills and pay their employees and service their debts and buy goods and services that they need to turn into something else.
But it will be worth as much.
Well, here's the thing. What we're talking about with the FDIC here is, again, they did this on the fly, so we don't really know how this is going to play out. My gut is basically the Treasury sort of prints the money to cover these debts now, and that is somewhat inflationary. That's why, that has its own issues, and that sort of was considered by the markets today to be a liquidity injection at some level. Over time, if this is going to be the new insurance regime, the banks are going to have to pony up more money in insurance payments, right? I mean, if you're a poor, if you're a good driver with no accidents, you pay less in insurance.
Right.
If you're a crappy driver, you have to pay more. And if you go, and if you trade in a Subaru and for a Mercedes, your insurance premium is going to go up because what you're insuring is a much bigger number.
But aren't the banks going to pass that on to the consumer and the businesses that they bank with?
Yes, it's going to be more friction. So here's the trade-off. Now, that's not necessarily a bad trade.
Okay.
The trade is, am I willing to receive a little less in interest payments from the bank in exchange for a safer and sounder banking system? I think that's a reasonable question to ask. And the details are in the mechanics. I think that's not, that in and of itself is not at all problematic. It's not at all socialist, et cetera. The problem is if we just sort of say, okay, we're just going to keep willy-nilly you know, we're going to subsidize depositors whether or not we're properly insured for it, and then just print the money to pay them off and make this a permanent thing. That's problematic. So the first thing I laid out, that's a choice, right? And that we all have choices like that. Do you want to take collision on your car? Some people do, some people don't. You know, if you got a car that's kind of a piece of crap, you don't want to pay collision insurance. If you got to, you know, and I've been in that situation where I've just taken the collision off because I was driving around an old car. If it, you know, and so, but so if we can do that as a society, as an economy, and make those choices in a rational way, then I don't have a real problem with that, because that's insurance is a risk transfer mechanism, and that's okay. Insurance markets work because risks get transferred and through some, you know, and the insurance company is the transferor of the risk. The problem is if we just sort of say, you know, forget any concept of insurance and premiums, and we're just going to keep the premiums the same. Or we're just going to basically say, you know what, we don't really care what banks do, and, you know, let them do all these crazy things, and the depositors will be made whole no matter what. That goes back to the, you know, privatizing profits, socializing losses, because it incentivizes bankers to take risks with depositor money that may not be at all appropriate. Right. You know, the other problem we get into is people clamor for deregulation when times are good, because it's seen as this impediment to the profits that can be out there that we can make. But then people clamor for more regulation when something like this happens. When sort of and it's sort of inevitable that as you deregulate, you will find someone will find the holes in the regulation.
I think that makes sense.
The problem is in many cases, it's the same people who clamored for the deregulation who then clamor for either support or re-regulation, and that infuriates me.
Well, in a perfect world, I think that would make sense, right? You know, the rules, it shifts like a tide, right? Cyclical. We mentioned about cycles earlier. When things are good, yeah, peel off some of the red tape. Everyone's playing by the rules. No one's cheating. Once someone cheats, you put the rules back in there. And then once everyone kind of settles down, you start to alleviate the rules, and then it goes back and forth. To me, that makes sense. But the same people who are alleviating the rules are the ones who are calling them back. Yeah, I understand why it's infuriating. It's like they're playing. It's like, are they playing both sides? Is that kind of what it's like?
Well, yeah. I mean, I gave you the example earlier, you know, again, about the published report about the guy, you know, lobbying to not have SVB be a significant, a systemically important financial institution.
Yeah, they cited the low risk profile of their activity and business models, to which, where? Looks like they got that one wrong.
No kidding. And so that's exactly it. So times were good. They didn't want the red tape. They didn't want the hassle of regulation. They were growing fast. They were growing and didn't want to have to deal with the extra hassle that this was going to cause. Guess what? It turns out they were a systemically important institution, because we had to go bail them out to avoid a financial crisis.
Again, we'll bail out the banks again. You know, we just bailed out the banks in 2008, which 15 years ago is not a long time.
Remember, it's not necessarily bailing the banks out. See, this is another interesting little misnomer. The banks, in this case, we're bailing out depositors. We're not bailing out the owners of the bank, and we're not even bailing out capital market lenders to the banks. Even in the era of you know, the quote unquote bailouts, what were we supposed to do? We were just supposed to let Citibank vanish. We learned, you know, we did that. They did it with Lehman Brothers, and that didn't work out well. So they had to come up with some mechanism that would allow the banks to keep functioning, because remember, it all goes on confidence, and confidence was at an all, you know, impossible low, it seemed. So they came up with these mechanisms. One can argue again that the government didn't charge enough for their services to backstop these banks. But I think it's a little quick to say it's a bailout, and I would certainly argue that in the case of SVB, the depositors were bailed out, but the banks themselves, you know, the bank itself wasn't bailed out. The bank doesn't exist anymore. Their assets in the UK, which were sold for £1. So there was no bailout there for the bank itself. And so we have to be very careful with the terminology.
Fair enough. Thank you for making that distinction. So yeah, I think, okay, in that case, depositors, so the people who are using the bank got bailed out. That makes sense. So this idea of a bank can just do what it did, do what it does, and no matter what, it's going to be bailed out. Now, that doesn't sound sustainable. It sets the precedent that banks can just do whatever they want. They can be reckless. They can pump their stock when it goes crashing down. Oh, here comes Big Daddy government to save the day. With no accountability being taken. Now, in this particular circumstance, we don't know if there should or shouldn't be accountability. Like you said, we're not lawyers. But doesn't this set a bad precedent that the banks, if other banks are, now other banks are definitely looking at their stuff going, uh-oh. Whether it is or it isn't, they're looking, right? They're going to be looking, as they should be looking. But we shouldn't have this precedent of no matter what, you're going to be bailed out. Just do what you do. We don't care what it is. We're going to bail you out. So we do need some restrictions. We do need some regulation. I hate regulation. But you
need it here.
You do need it here. Regulation regulation is where you need it, right? You can point to plenty of examples across the market where regulation is ridiculous, whether it's from unions or from this or that or the other. It's too much red tape. But in this circumstance, this is our banks. This is the money. This is literally the confidence which the market runs on. Yeah, regulate the shit out of it, of course.
And this becomes the issue, because remember, one of the phrases that you hear a lot is other people's money. And so if you have no regulation, you're incentivized to do crazy, to take risks with other people's money. It becomes heads I win, tails you lose.
Yep.
If
sounds like the government to me.
Well, I'm thinking from the banker point of view. If I have no bank regulation, and I'm taking in these deposits, I'm incentivized to just take whatever, I'll take whatever crazy risk I can with that money, because if it works, I'll get paid back enormously. If I'm the main stockholder in the bank, my stock will go up. I'll be able to pay myself a lot of money, and et cetera, et cetera. And if it loses, well, all right, well, I lose, but other people lose worse than me. And that's why you need regulation, because the banks are fiduciaries. We expect the banks to operate in some way, shape, or form in our best interests. The ironic thing here about SVB is, on the surface, they weren't actually taking crazy risks. They took stupid risks. They didn't understand liquidity. They didn't understand what might happen to liquidity conditions, to duration mismatches, to short versus long-term rates, et cetera. But they actually weren't lending it in crazy ways. A lot of the banks in the global financial crisis were lending it in crazy ways, lending it to making mortgage loans to borrowers who really had no business being able to pay them back. That's a crazy thing with other people's money, and a loophole in regulation. This was more just, again, this should have been caught. Someone was asleep at the switch, because they should have this should have been picked up earlier than it was. But this one, in many cases, this one is actually a strange one, because it wasn't necessarily, on the surface, it wasn't necessarily an undue credit risk. They weren't doing anything truly overtly stupid or risky with the money. They were investing it in very high credit securities. But the problem is they didn't understand some of the other risks that go along in banking, which are much less subtle than just credit risk.
So it all comes down to leadership, right? Like most things, it comes down to leadership. So I'm glad you mentioned leadership, because one of the leaders, a man named by the name of Joseph Gentile, if you don't know who that is, he was the former chief financial officer at Lehman Brothers, global investment bank, which, as we all know, went bankrupt in 2008. So he was one of the head guys at SVB. Now,
was he really? I didn't know that.
Yeah, he was. So how does a guy who screwed up so royally at his last job land this job? That happens a lot in banking and corporate America. Regardless, you fail up. Politics, like a lot of the people who caused the crash in 2008, again, completely different than here, but all those people who caused that crash still got their bonuses. They got fucking new jobs. They got, promoted. So how these people who caused these crashes, again, I'm not saying this guy caused the crash, but how come this is that common thread, poor leadership? These poor leaders don't get any consequences. They don't lose their jobs, and they just move around and make the same mistakes all over again.
I've always noticed the phenomenon, and I was having this conversation. I was out to dinner with some guys I know from the industry a few weeks ago, and we were talking about some people we knew who seemed to fall upwards.
Yeah, happens a lot. Happens a lot.
It does happen a lot. Usually they're very presentable. They're in with the right circles, et cetera, et cetera. There's also a strange Wall Street phenomenon, and that is, if you just have like ordinary losses, you get fired. If you lose some spectacular amount of money that puts you on the front page of the Wall Street Journal, a lot of times those people come back and people lend them more money, figuring, well, they're good risk takers and they screwed up that one time and they're not going to make that same mistake again. It's happened. You're shaking your head, but it's happened.
I know. That's why I'm shaking my head, because it makes me angry.
I don't know. I've never been, as far as I'm concerned, I've had to like work hard to maintain, an upward trajectory. I've never been one of the people who figured out the means to fall upwards. There have been people to crack that code. I didn't realize that there was the Lehman Brothers connection here. You would have figured he would have, but this was actually different.
That's my point. There were no consequences. Nothing happened to him. How can you learn from something if you don't get punished? If there's no consequences.
That's a whole other argument. We don't have enough time for it. I'm starting to lose my voice having talked all day. Yeah, I mean, we have to like I said, like with the insurance, we have to figure out what the right insurance system is. We probably do need to figure out there has to be checks and balances. It's pretty clear that the consequences to screwing up in this manner tend to be just financial, and it's not even clear they're big enough financially. But that's a whole other societal discussion, and it's another one that we're probably not likely to have anytime soon.
Little too big to talk, Talking with Tarashuk podcast, but my audience isn't big enough to people to care. Okay, so before I let you go, I was talking to some about venture capital. They're looking to get into VC, so I promised them I would ask these questions. How is this going to affect the startup industry? And like, what does it mean? Because, this bank had a lot of venture capital firms, a lot of tech startups. So what happens to tech? Did the bubble just burst? And then what happens to VC who are looking to give out funding to these companies? And I have a follow-up question after that. But tech, what happens to tech and VC funding? Okay.
Not being a venture capitalist or having dealt in that world, I'm going to have to talk a little abstractly. If they're good, there's always going to be money for good ideas. That's human nature. People want to back the next big thing. And so there will be money that flows. There'll be money that flows to it. But I will argue that the money has stopped flowing some time ago. The easy, crazy, stupid money kind of petered out around 2021, 2022. That was the whole point of raising interest rates and quantitative tightening by the Fed. Not necessarily to squash venture capital, but money was getting deployed in crazy ways. The whole cryptocurrency industry, I will argue, would that have a thought experiment, which we don't have time to solve here? Would crypto have been a thing if interest rates were always 4 or 5%? I'm gonna argue no. It became a thing when money was essentially free. When money gets more expensive and more scarce, there will still be people looking to deploy it, because if you have a great idea, if you invent something wonderful, or you have some methodology of doing business that's going to be incredibly profitable, well, people are going to want to finance that. And people want to finance that if rates are 0. They'll want to finance if it's 5%. They'll want to do it if it's 10%, because if the promises are that high. What they're not going to do is finance just some wacko idea, or just because it sounds good on paper. And that's a lot of the stuff you saw happening. So taking away SVB will make life a little more difficult in the short term, but it's not going to stop. The process of innovation is going to go on. People are going to fund that innovation. People are going to want to profit from that innovation. So I think it's a hiccup, but more or less, I'm going to call it a speed bump rather than anything else right now.
All right. So you think it's still a good time to look to get into the world of venture capital? If you're looking for jobs in VC, it's still a hungry market out there.
I can't speak to that because I've never looked for a job or had a job in venture capital. I'm going to say as an industry, it's going to continue to exist. Right. But like any other industry that involves investment and deploying money, there's more of it to go around when money is cheap. The people who give the money to the venture capitalists to invest are more willing to take risks with it when returns are low. When returns are high, you have to seek out better types of returns, and so it becomes a little less plentiful. So I don't know anything. I'm not even going to pretend to know the job market in VC. I can't answer that part of the question. Excellent. But from a 30,000 foot view, it's here to stay. It's not going anywhere. And, especially since they didn't all get wiped out by losing their money that was on deposit at SVB, it'll be around to be deployed and invested in something else.
Fair enough. Well, I hope that answers your question, friend. Steve, that was an hour. We had an hour and 5 minutes, and who's counting? But that went very fast. Thank you so much for your time. I appreciate it. But before we go, the final question, the Talking with Tarashuk podcast, always goes to the guest. So you've known me a little bit now, behind the mic mostly, but now you know me in front of the mic. If there's anything you've ever wanted to ask me about anything in life, money, podcasting, whatever, ask away. You got one question. You can always plead the fifth.
No, I'm not going to plead the fifth, but I'm going to give you one that won't embarrass you or get you fired from your day job. But
please.
Tell me the stuff you like about working, like and dislike about your role at NASDAQ, which is how I've gotten to know you.
Oh man, that's a tough question to answer. Well, I think my favorite part was
without getting yourself in trouble. I don't want to get you fired.
Oh,
let me be very clear.
I could say anything, and Jill will just be, Jill's my number one. The best part's working with Jill, honestly. Having a boss and a superior who is so easy to get along with, easy to work with, lets me explore ways to grow, lets me explore ways creatively, gives me the runway, and also to just do what I need to do the way I need to do it. But also, if she needs to ring in the leash, I have that respect for her to where I can, remember that she's my boss. And one of the best things I did was I had her on the podcast. Jill is my boss.
Yeah, I do know that.
She came on my podcast. I brought her to the studio in Montclair, New Jersey, kind of showing what I have going around because she does know. Also, she lets me explore other things outside of the job. So, I'm the founder of Ambiguous Podcast Solutions. I'm technically a contractor, so I have a lot more runway to work with. But my podcasting is completely separate from my day job. And I try and kind of tiptoe the line of what I can and can't do and resources I can and can't use. And another good part of working there is that I have no issue with that because I can ask, right? If I had any issues, I thought of bringing you as a guest on, I could just ask and she would tell me no and I wouldn't do it. It's simple as that. So there's transparency, there's leeway, there's plenty of room to grow, whether it's at NASDAQ or outside of NASDAQ. So I like to keep them separate. I like to keep the fact that I work there and Ambiguous Podcast Solutions and my podcasting business and my work in podcasting separate as much as possible, just so there is no conflict. It can't be conflict if you don't introduce each other. But sometimes they do cross over. This bank crash happens and I need a guest last minute. And I was just like, oh, who can I think of? And bam, Steve popped into my head because you were just talking with us. And you're a man I respect very highly. You're on with us frequently. You're excellent behind the mic, so I know you're good at this. I knew you would be able to handle my questions, whether there's some boneheaded or some whatever. You can handle my pushback because I'm a millennial. I'm very cynical. I'm not very confident. I'm not confident in the markets. I'm not confident in the government. But I think just in our conversation, you kind of pushed some of that confidence back into me. So I really enjoyed it. So thank you.
Well, thank you. I enjoyed it too, and I'm glad you think as highly of Jill as I do. You obviously work with her every day. I'm fortunate enough to talk to her a couple times a month, or more frequently as time allows. And I've always had that impression of her. I'm glad to hear you echo it. So that's wonderful.
Excellent. All right, Steve. Anything you want to share? If you have social media, the company. Whatever you want to share, promote, the floor is yours.
Well, my Twitter is @Steve Sosnick. Please follow me. I'm not the biggest social media presence. I'm not a millennial, so I'm not a social media native, but I think I occasionally pepper it with some things that are useful. I write pretty much daily for Interactive Brokers. the Traders Insight. We've actually rebranded it as IBKR Campus, which I haven't gotten an updated backdrop. But that really has a lot of educational stuff, not just the stuff that I write, but we have all kinds of educational stuff about markets. You want to know how to price bonds? There's a bond pricing module. You want to know how options work? There's an options pricing module. So we have a lot of educational content on there. For both new and experienced investors and people who are interested in the market, and it's all free. And so those are really the two things I'd like to, I hope I could get across today.
Awesome. Excellent, Steve. Thank you so much again for being a guest on the Talking with Tarashuk podcast. Ladies and gentlemen, my name is Will Tarashuk. That comes to a conclusion of the show. T as in Thomas, ARASHUK, all my things. The Talking with Tarashuk, TikTok, at Talk with Tarashuk, Instagram, where all the reels and clips will be shown from this podcast. I'm probably going to get about 15 to 20, so that's going to be exciting. YouTube, Talking with Tarashuk, all the full shows, playlists, and everything. The podcast is available on all audio platforms. This is going to go on the Money playlist. This is going to go on the Clips playlist and the full shows playlist. Maybe one or two others. I'm not sure yet. We'll see what goes. All the audio and the clips are there. If you want to support the show, link in the description down below. I always forget to do this, but I'm going to remember now. The GoFundMe for Ambiguous Podcast Solutions. Yes, we're talking about assets and debts. Well, I got a little bit of both. So help me in wiping my debt clean. If you need a microphone, you can go to our store. Also linked down below to start your own podcast. Any interest in the podcast, want me to host your podcast, reach out to me, will@apspodcast.com, or give us $5 to the GoFundMe and help support the business. Next week, I am talking to a man who's been in podcasting since 2005. He was a guest on the Ambiguous Podcast Solution a year ago. We're going to catch up with Keith Hayes. I'm very excited to talk to Keith. He was supposed to be on tonight, but I got Steve to bump him. So thank God for Keith. Thank you. Shout out to you. Steve Sosnick, thanks again. One more time. My name is Will Tarashuk. That has been the podcast. We'll see you next time. But until then, y'all take care.